For years, the world's biggest banks have publicly just dismissed Bitcoin. But according to the analysis we're digging into, a huge shift is happening right now, one that could completely rewire the whole relationship between traditional finance and this digital asset. So, we're going to break down a pretty bold prediction for 2026 and what it might mean for the future of money. It all kicks off with this quote, which is attributed to one of the biggest banks on Wall Street. This is supposedly the moment they just stop fighting Bitcoin and start selling it. And this one sentence, according to the source, really captures the heart of this massive industry-wide reversal. So how in the world did we get here? Well, the analysis points to four key things. We'll start with the big reversal itself, then we'll look at the regulatory green lights that made it all possible. After that, we'll dive into the three powerful institutional engines that are set to drive all this capital, and finally, we'll unpack what it all means for the market. All right, let's jump right into this reversal. The source paints a picture of a complete 180-degree turn from the banking industry's public stance on Bitcoin. We're talking about a shift from, outright condemnation to deep, direct financial integration. And this slide just captures that contrast perfectly. On one side, you have those infamous rat poison quotes. That was the old way of thinking. On the other side, the new reality. Banks aren't just selling someone else's product anymore. They are manufacturing their own Bitcoin ETFs, owning the entire process from start to finish. And let's be super clear here, this isn't some big philosophical change of heart. The analysis is pretty blunt about this. Banks follow the money. Bitcoin now represents real, monetizable demand. We're talking ETFs, custody, collateral. And where capital flows, you better believe fees are going to follow. But look, a dramatic pivot like this doesn't just happen in a vacuum. And that brings us to our second point, the regulatory changes that basically flipped the switch, giving banks what the source calls a state-sponsored green light. You can see on this timeline how all the key dominoes fell into place. First, a huge accounting roadblock, this thing called Staff Accounting Bulletin 121, that got tossed out. Then the OCC gave a clear path for digital asset custody. And finally, a crucial change was made to Basel III, which is the set of international banking rules. So that first domino, SAB 121, was a massive roadblock. It basically forced banks to treat crypto they were just holding for clients as their own liability, which was incredibly expensive from a capital standpoint. Getting rid of it completely flipped the economics, turning custody from a huge risk into a profitable, fee-generating business. And this chart, wow, this shows you the final crucial piece of the puzzle. Just look at that first bar. Under the old Basel III rules, which tell banks how much cash to hold against risky assets, Bitcoin had a risk weighting of 1,250%. The source calls this nuclear waste territory. The revision dropped that all the way down to 100%, putting it on the same level as equities like Apple stock. This is what financial normalization looks like. So, with the regulatory path all cleared, what happens next? The source identifies three major institutional engines that are now primed to drive a constant flow of capital into Bitcoin. And we're not talking about your average retail hype cycle. No, this is the big financial machine itself starting its engines. These three engines all work together. First, you've got automated ETF allocations from these huge wealth management platforms. Second is the use of Bitcoin as recyclable collateral in the core lending markets. And third, the steady, recurring revenue that banks can now pull in from custody services. To really get a handle on that first engine, you have to start with this number, $33 trillion. That's $33 trillion. That is the total pool of assets managed by U.S. financial advisors. And now, Bitcoin ETFs are plugged directly into these platforms. And when you do the math on that, it is just staggering. A super conservative 1% allocation, just 1% across that massive pool of capital would create $330 billion in new demand. And this isn't hype-driven buying. This is automated, model-driven portfolio stuff. So, the second engine is all about collateral. The source highlights that major firms are now accepting Bitcoin in repo markets. Now, this is like the critical plumbing of the financial system, where institutions make short-term loans to each other. It means Bitcoin can be used to back loans, just like a U.S. Treasury. It can be borrowed against, reused, recycled, creating real monetary velocity. And engine number 3 is custody. This isn't just a simple service, it's a high-margin, recurring revenue stream. This gives the banks, as the source puts it, skin in the game. They now have a direct financial incentive not just to hold Bitcoin, but to see the entire ecosystem grow, making the asset more valuable and more mainstream. Okay, so this brings us to our final section. What happens when you smash together these powerful, persistent institutional demand engines with an asset that, well, has a famously fixed supply? And that's really the central question the analysis leaves us with. It's a classic Econ 101 setup, isn't it? What happens when you have massive, relentless, automated buying pressure hitting an asset whose supply is literally hard-coded and cannot change? It's a scenario Bitcoin has never, ever faced on this scale. Well, the source's answer is that you create something they call a perpetual structural bid. So what does that mean? It's perpetual because this demand isn't a fad. It's not based on sentiment. It is literally built into the financial plumbing now. And it's structural because it comes from the very architecture of wealth management, collateral markets, and custody services. So when you step back, the story here is really about a massive transformation from a speculative sandbox to a fully financially industrialized asset. The very institutions that once dismissed Bitcoin are now building it into their core operations. The only question left is, what does a world where the banks are the biggest bulls actually look like?